So my name is Victoria. I'm actually one of the attorneys with the Copenbarger law firm that focuses on estate planning and how that affects your taxes to a degree. Sunny Boren was going to be the one to do this presentation. She unfortunately came down extremely sick, so we are praying for her quick recovery, but you are going to then be hearing from me today. With that being said, for everybody on the webinar, you do get a free consultation with Sunny and her team for attending this. So I absolutely encourage, if you have further questions, if you need our services, if you want to meet with her specifically, please take advantage of that free consultation. So we're going to focus today on tax planning. So I know we just started the year. And so for some people, they're going, well, it's a new tax year. Do I really need to be thinking about this stuff already? Isn't this stuff that normally we should be focused on towards the end of the year? The reality, though, is a lot of times if you wait too long to start thinking and planning about your taxes, it can end up being too late. So we want to make sure that you have the right information now so that you can strategize for the entire year and you don't wind up in any kind of a time crunch, at least an avoidable time crunch towards the end when the holidays are also in full swing. So to get us started, I just want to go through quickly and say this is a lot of information, and it's a lot of information in a relatively short amount of time. So again, we encourage you to ask questions. We'll address the ones that we can, but also take notes. A lot of times the notes that our clients bring after attending these different events are the things that allow us to really address what matters most to you, what are your concerns, and how can we best assist you. So to get started, though, for anyone who doesn't know us or hasn't been to see us in a while, I want to give a quick introduction or reintroduction to our team. So we have quite a large team of attorneys that not only focus on estate planning, but obviously with this webinar, focus on more advanced planning needs. Now, advanced planning doesn't just mean you're in the uber 1% and you have millions and millions and millions of dollars. Tax planning and business planning can absolutely be an intimate conversation. You have a new startup that you're trying to get launched and you need assistance forming it. You need assistance with what am I going to look at when a tax consequence comes? What if I hire an employee? Is there any liability with that? Do I have to now report 2 income taxes? There's a lot that is done with the business and tax department that goes beyond the estate planning component that Copenbarger is often known for. We also have an estate administration department. The reason that we have this department and it is such a vital component of what we do is, unfortunately, at some point we all pass away. And at that point, something needs to be done. Whether it's your estate plan needs to be administered, your business needs to be transferred, somebody new needs to file a final tax return. There's a lot to be said about what happens after somebody passes and how everything then comes into play. We also have an estate litigation department. Now, we obviously hope that people can stay out of court, but we understand sometimes it's inevitable. Maybe people are fighting. Maybe there was a miscommunication or a clarification that wasn't done when you were alive, and now your beneficiaries are having to figure it out after the fact. There's varying reasons that things unfortunately have to go to court, but that is all to say that the good news with the Copenbarger law firm is that we can keep everything in-house when it comes to your planning needs. But we, of course, could not do what we do without our incredible staff. So our staff is the reason that we have been able to serve as many clients as we have for as long as we have. So these are the people that help make sure that you get your questions answered in a timely manner and make sure that we are able to assist you as efficiently as is possible. We also have offices all over the state. And so depending where you are, the good news is for most of our clients, we have a physical location close to them. However, that's not the case for everybody. And so we also do things on Zoom, the phone, and for some of our locations where we have big client bases, we are even able to go and do remote offices there. So if you need us, just let us know where, when, and how. So the first thing I'm going to jump into are legal changes. These are laws that affect your taxes or your beneficiaries' taxes. And these are things that you want to be thinking about now. A lot of legal changes that we talk about in this section are things that you really need to make sure you pre-plan for. Again, once you pass away, a lot of these options disappear. So first and foremost, why do you need to care about the legal changes? Obviously, with life changes, people are more aware of them because it's happening to them. But with legal changes, we very much encourage our clients to come and see us every 3 to 5 years, because the legal changes often are the things that can have very profound impacts on what happens to your money while you're alive, what happens to your legacy and money after you're gone, and ensuring that you don't have to pay anything extra, or your beneficiaries don't have to pay anything extra that wouldn't have been needed otherwise. So first and foremost, I'm going to talk about Proposition 19. So Proposition 19 deals with your properties. So this is in California properties, to be clear. This is your residence, your rental properties, your business properties, your land. It's all of the real property that you own. Now, there were some good things that came out of Proposition 19, but there were unfortunately some negatives that were not widely advertised when this proposition was coming into effect or being voted on. So the good component of it is that if you are a senior over 55 years old and you are looking to move within California, you can actually move into any higher cost basis home in the state and retain your current lower property tax base. And you can do that up to 3 times in your lifetime. So that is a positive, that if you were looking to move, this is then a benefit to you, that you can move your property taxes with you to a home that is worth, at this point, more than your home was when you originally purchased it. The problem, though, with Proposition 19 is what happens after you pass away from an inheritance standpoint. Anyone who is not a child or a spouse, but we're going to talk children right now, if you do not have your properties left to kids, no matter what type of property it is, unfortunately, the law now says that the property taxes will go up to the current value. If it is going to a child, the only property that can keep your property taxes is your primary residence, and only if that child chooses to live in the property and own it as their primary residence. So it's extremely restrictive. So what comes out of this is, well, okay, that's all great and, well, not great, but what can I do about it? Is there anything that we can do at this point to help prevent that property tax rate from going up astronomically? The good news is yes. So as far as we're talking today, we're going to discuss LLCs when it comes to Proposition 19. If you are going to purchase a new home, come and talk to us first. If you form an LLC before you buy the new property, and you then have cash in the LLC or assets that are able to purchase that property directly using the LLC, you can actually then transfer that tax basis after you pass away without it having to be reassessed in certain cases. So especially if you have rental properties, or that's what you're going to be purchasing, if you're going to be purchasing land, if you're going to be purchasing a commercial building, this is the time then to talk about an LLC before you actually make that purchase. Unfortunately, this is not something that can be used retroactively. So if you already own the home, you unfortunately then can't set the LLC up and transfer it in and have those same advantages. So if, again, you're looking at purchasing, come and talk to us before you do it. Another tax and legal change that has occurred is the Secure Act. Now, the Secure Act is dealing with your retirement money. So if you have a 401k, an IRA, a retirement account, this is going to pertain to you, or again, to your beneficiaries. So most retirement plans that you have are going to be transferred by beneficiary designation. So generally you have specific individuals that are named on those accounts. The reason that this is a conversation is because, unfortunately, that's not always the best option. There are times that beneficiaries are not really equipped to inherit money without additional protections or guidance around it. And so there's different ways that you can still leave the money to those people, but you can put guidance and protections around it that A, may protect them from themselves, but B, may protect them from outside predators. So what happens with the Secure Act? So unfortunately, the Secure Act was yet another tax implicated for us that essentially involves the government wanted more money. They did not like that there was becoming generational wealth that they could not tax for years and years and years. And so what it means is that with the Secure Act, if it is a non-spouse beneficiary, they have to withdraw the funds after your passing within 10 years of your date of death. So for a lot of people, especially in the generations of my parents, my grandparents, my great-grandparents, They were told you put money in retirement. So they built and built and built their retirement. Well, if you're like me and an only child, or you have families where at the time the kids are inheriting, they still have their own income, that 10-year clock can lead to extremely high taxes as you're pulling that money out and adding it to your own income. So it is something not only for you to be aware and to plan for now, but it is something for your beneficiaries to be aware of as well. Now, there's other components of the Secure Act that we very much encourage you not only to talk to us about, but also, frankly, to talk to a financial advisor about, because the rules changed as far as how much longer in life you can be giving to an IRA, when you need to withdraw things, so the required minimum distributions, how much you can put in. Things have shifted, especially under the Secure Act. So not only come and talk to us, but if you do not have an advisor, now is the time to talk to one. Again, these are things that planning for ahead of time, it gives you and your family more options. Waiting until the very end, or having never done it and then passing away, can have significant tax consequences that could have absolutely been avoided. Now, I mentioned that I was talking about children. Spouses are not under this 10-year rule. So if your spouse is inheriting your retirement account, they do not have to then be concerned about that. There's a few other exceptions. And so if you have a beneficiary that falls under one of these, they do not then have that same 10-year rule. But most people that we talk to, and most of the people whose beneficiaries are listed, they are people where this is going to affect and impact them. So again, come and talk to us. But again, a few other takeaways from it. So the penalty for failing to take your required minimum distribution actually decreased from 50% to 25%. So that is a positive. In 2024s, they're actually not required to be taken from Roths in employer retirement plans. But again, as I mentioned, who are your beneficiaries? You can set up different trusts to actually be those beneficiaries on the retirement accounts if you believe your beneficiary needs additional protections, but you have to do it in the right way. So because the Secure Act changed so much so drastically, if you already have a Copenbarger trust, it is extremely important to make sure you've seen us since 2020 and that you have the correct retirement language in your trust. If you are not a Copenbarger client and you do not know if you have the right retirement language, we are more than happy to take a look at it. But as you're planning for your retirement accounts and who should be the beneficiary and how should they receive that money, it's important to ensure that your documents all comply with the current law. So the next tax I want to talk about is the gift tax. So gift taxes are probably one of the most misunderstood taxes that we have. The reason I say this is most people know about their annual exclusion, but they don't know about the lifetime exclusion. So first and foremost, gift taxes apply to transfers made during your life. So if you are gifting something to another person, it is then technically going to fall under a gift tax component. But there are certain gifts that are excluded. First and foremost, now that we're in 2024, the gift tax exclusion has gone up to $18,000 per person annually. So what that means is if you have 5 kids, you could give each one of them $18,000 and never have to tell the IRS. But the part that is misunderstood is the lifetime portion. A lot of our clients think that if they gifted $20,000, let's say this year, that $2,000 excess would be taxed. What actually happens is that $2,000 gets reported to the IRS as a gift in excess of the 18, but it gets deducted from your lifetime exemption. So unless you are planning in this year to gift more than $13.61 million, you would actually not pay a gift tax. That extra $2,000 would just deduct from the $13.61 million. This, though, again, is a fluctuating number. I mentioned that this is as of January 1st, 2024. That is in part why it is so important to come in and talk to us, at least on that every 3 to 5 year basis, because as these laws change, the tax components change, it is extremely important to make sure you come and talk to someone who knows what they are doing to properly advise you. If the exemption ever goes down, if the gift per year goes down, you also don't want to accidentally gift in a way that could cause a tax simply because you didn't realize it had adjusted. So all that is to say, come and talk to us if you have any questions. Now, there is also the federal estate tax, and this is the tax that applies to transfers that are made at death. So this does not generally apply to spouses or to charities. So that is a very good thing, and we will be talking about charitable giving today. But this is something to be aware of, that when you pass away, depending on the size of your estate, there could be yet another tax that you need to be concerned about. The great news, though, is that here at Copenbarger, we have a lot of strategies to make sure that this is a tax that does not apply to your estate. So, again, come and talk to us. With the estate tax exemption, when you pass away, the federal government is going to look at what was the size of your estate. What was it at the time that you passed? Now, if you are a married couple, and let's say the exemption, just to use round numbers, was $6 million, but in your estate was only $3 million when you passed away. I say only, that is still quite a sizable amount, but from the exemption standpoint, it's half. Your spouse can actually elect to add the unused portion to their lifetime, which means that when they pass, if the estate has grown, if the exemption has gone down, and there would have otherwise been a tax, they can apply your unused portion to protect that extra money. So that is something to absolutely talk to us about if unfortunately you've lost a spouse and you are concerned about any potential taxes in the future for your beneficiaries. But the issue with portability is there is a time clock on this, so it does not happen indefinitely. You can't come and see us 5 years later and still have this. We recommend, if you do lose a loved one, to come and talk to us within a few months after their passing, to at least make sure that there's no timelines you need to be intimately or quickly aware of. The other issue, though, to bring up with the federal estate tax is that there is a sunset provision that is going to occur in 2026. What that means is that the exemption is going to be reduced by almost 50%. So I use that $6 million example very pointedly. We are expecting that the exemption will be somewhere between $5.5 and $6 million in 2026. Now, for a lot of us, that still then doesn't lead to a concern. But for many of our clients, that does then lead to, okay, I was protected today and over the next couple of years. But if it reduces that far and I have my business, my residence, my rental property, my cash, now I'm going to have an issue. How can I make sure I don't pay unnecessary taxes? So there's a few ways that you can do that. One of the ways is by gifting. So if you gift to charities after you pass away through your planning, that money deducts from what can be taxed. So that can be a huge way to make sure the government doesn't get the money, but that you're able to contribute to a charity you cared about, your school, a hospital, some sort of organization that can benefit from it, again, rather than the government. You can also, if you know there's an issue, what many people have done then is they start gifting now. They have a schedule where they look at, okay, we're going to give this much to this many people each year, and that's going to roughly deduct us to this level. Again, that's where working with a qualified professional, though, to map that out and have a schedule can be extremely valuable. So that's another piece. You can also give with an LLC. So LLCs have a lot of benefits a lot of people don't fully realize. And so that is, again, where Sunny and her team can add a lot of value that you may not have even realized was there because it's not as widely talked about. Now, next, income taxes. Again, everybody loves taxes, don't they? And income taxes, we have to pay them no matter what we would like or not like. So it's important with income taxes to be aware of when things can change. Now, some of these you may be intimately familiar with because you've gone through them. Other ones you may not have even considered. For the purpose of today, especially if you have a new business or you're going to buy or sell real estate, and especially then if that promotes you into a new tax bracket, you need to talk to somebody about your income taxes. Because for a few reasons. One, as things change, you need to know what those changes are and how, if anything has changed, you now need to report. But the other thing is, you may be thinking, oh, shoot, now I'm in a better position financially, which means my taxes went up. You may not realize there's ways to offset those income taxes. So there's different strategies that can be done to help prevent taxes from being astronomical. Not in all cases, but if you don't ask, the answer is always no. This is, again, where we're going to talk about LLCs. So with a single member LLC, if you have one, you don't have to file a separate tax return. That is one of the biggest questions that we actually get is, okay, if I have any kind of business, do I automatically have to file a separate tax return? If you're the only member of it, the answer is no. If it's a multi-member LLC, you actually have a few more options. You can actually elect for what's called S corporation taxation to save 15% in self-employment taxes. So again, there's different strategies. Just because you have an LLC doesn't mean it's necessarily cut and dry. If you're gifting LLC interest to beneficiaries, that's then going to have an impact on your taxes and what you need to be focused on and report, because a beneficiary then will share income and the taxes. So if you're looking to spread it out over more people, if you're wanting your beneficiaries to get involved maybe now with a business that you have in the LLC, that can be a way again to spread things out, but it's something that you need to discuss before you have done something in a way that may or may not have been correct. Another piece with the LLC is that it can protect your nest egg as well as the corporation. So one of the things at Copenbarger we really focus on is ensuring that you or your beneficiaries do not pay anything extra, especially in taxes, that could have been legally avoided. There are a lot of different strategies and methods out there, but the government obviously doesn't want those advertised extremely highly. So it is important, again, to work with a qualified professional who knows about the different advantages and as a result can then apply them to you. One of the biggest advantages with Sunny is that we can actually form LLCs in all states. So there are different states that offer more privacy, they don't have income taxes, they have more advantages to them. And we can actually form them in any state that is going to be the most advantageous to you. So if you're not sure you actually want a California LLC, rest assured we can still then be of assistance. Now, other ways, again, to reduce your income taxes. So charitable donations, I mentioned, that's a huge one, especially if you already have charitable intent. That can be a great way to make sure the charity still benefits and your income taxes go down. You can also do contributions from your IRA. You can have an HSA, and you can have tax credits for any American-made EV or plug-in hybrid cars. So there's different deductions that, again, people aren't often aware of, because why would the federal government or your state government want to advertise these deductions? They want the taxes as high as they can be, for better or for worse. And so it's, again, important to make sure that you talk with someone who can look at your life, look at what you've done in the year, look at what you own, and ensure that you have any deduction possible to reduce those income taxes. Now, charitable giving is a huge part of what we do at Copenbarger. I would say the vast majority of the people that we have worked with also have a lot of charitable intent. And a lot of times it's because giving feels good. It is one of those things that when you give to others, it has an inherent way of just making you feel happy. And so with charitable giving, it's not just something that you can do during your lifetime, it can also be something that you do after you are gone. It is something that can happen after for your beneficiaries then to partake in and have an active role, especially if you have a charity that was extremely important to you and you want to make sure that that legacy carries on to your children. And there's a lot of different ways that you can give. And so I want to focus on especially the trust component. Trusts are not utilized enough when it comes to charitable giving, especially if you have an estate that is a certain size where you're giving a significant amount or a substantial amount. Now, there's certain gifts that the IRS actually does not consider cash. So those include non-material assets like stocks, bonds, and non-cash currency. So that is, again, something to make sure as you're giving and gifting that you are aware of. Now, when it comes to the trust, there's a couple different types of charitable trusts to focus on. With charitable trusts, it can be a huge benefit not only to the charity, but it can also actually be a benefit to you in ways, again, most people aren't fully aware of. One of the big things with a charitable trust is that it can actually provide a stream of monthly income payments for a certain number of years or the lifetime for you or your beneficiary. When the trust term is over, any property that is remaining will just go to the charity. And those properties or property given to the charity is given then in a tax efficient manner. What that means is that property, again, is then excluded from your estate when the IRS or the federal government is looking at what is a taxable asset that you have. The ones that are gifted to charity after the trust is over do not get counted against you or your beneficiaries. So again, this can be a huge benefit, especially if you have an asset that is income producing and has a lot of literal monetary value to it. Now, another piece of that is you can also avoid an immediate capital gains tax. With capital gains, that is a very large concern for a lot of clients, especially those who had bought property, let's say 20, 30, 40 years ago, even frankly 10 years ago, and they've seen the property grow and grow and grow. When you go to sell it, most people we talk to are very concerned about capital gains taxes. And so that is another way with a charitable trust that you can at least delay that tax from being applied and then strategize accordingly. Save what you need to, strategize with your CPA, with us, your financial advisor. It allows you to have more planning time. You can also take a charitable donation deduction over 6 years. But one of the ones that, again, is not talked about enough is keeping an income. For some people, one of the concerns with gifting to charity is, I then just don't have the asset. It's gone. And especially if you do need income produced to take care of you or a loved one or to help anyone that you would want to, that can be a very large concern of, again, just gifting assets away. So with charitable trusts, you can have that income produced so that the charity still gets the ultimate benefit of the asset, but you don't lose that benefit of income during your lifetime. So if that's a concern or a strategy you're interested in, absolutely come and talk to Sunny and her team. Then there's an even additional component to charitable giving, and that is foundation giving. So we have quite a few clients actually who their charitable giving intents are just astronomically wonderful. And one of the ways that they want to make sure that their beneficiaries also have that intent is by starting a foundation. When you start your own foundation, you get to choose your mission, you have the control, and your beneficiaries or descendants can be involved and then ultimately lead it when you are no longer here. That is one of the ways when we talk about legacy that it is a foundational part of establishing that legacy. Because especially when your kids can be involved, your descendants can be part of the mission that you wanted and created, it allows that legacy to continue in many, many cases for generations after. For other people where they're not as concerned about their children in particular carrying on a legacy, or they do not have children, it can also be a way that their legacy continues in a way that's profound. I talked to a client not that long ago, and they had been gifted a scholarship that was, when he was younger, it was the only reason he was able to go to college. He ended up being an extremely successful engineer in the medical field and was able to do quite a bit as a result of that scholarship. He then wanted to create a foundation dedicated to giving scholarships to people who didn't have a lot of money, but that were very focused on that field, because he wanted people to have opportunities that, again, he otherwise would not have had. That is a way that that foundation, it had nothing to do with children. It had to do with continuing something and giving back because of what he had received. So again, if you have any questions on that, please do come and talk to us. Now, next up, why does business and tax planning matter? Well, I think I've mentioned quite a few times that, again, a huge component of it is ensuring you don't pay anything extra in taxes, or your beneficiaries don't, that is absolutely legally required. Why give the government extra money that they don't actually have any entitlement to? So one of, again, the big ways that we do that is through LLCs. LLCs are talked about and understood on a very basic level by most people, and frankly, even by a lot of attorneys. But LLC advantages can be profound. Again, what type of LLC do you want or need? Do you need a single member limited liability company where it's a little bit simpler? It's you being involved. You don't have to file a separate tax return. The income is reported on your returns, but it has these protections needed. But again, you run the show. It is yours to do with as you need to. And again, you don't have extra income taxes that are reported or needed. Are you looking at a general partnership? Are you in a position where you want a multi-member LLC, where you need to talk about S corps or C corps? There's different corporation methods that can have, again, in oppressive impacts on the taxes that you are going to have to report and file and ultimately owe. But you need to be careful of double taxation. So this is not something to jump into without the foundational information. One of the CPAs that I actually talked to a couple years ago said he tells all of his clients, it is cheaper to ask me the question before than to have me have to clean it up after. So we would much rather have you ask the question now and there be no issue than not have the question answered or asked and then not, I apologize, to not have asked the question and then us need to help you on a more expensive basis clean it up on the back end. So if you are considering setting up a new corporation or business, if you're looking at changing the type of business you have, this is where talking to us can be a very big component. All right. Now with multiple member LLCs, they are taxed as a partnership, and this is often best if you are a real property owner. One of the big pieces, though, is that there are no gains or losses on distribution of property in most cases, and you can allocate income and expenses to partners disproportionately as long as they meet the tax rules. So this does give you a different level of control. This is a level of control where, again, especially when it comes to allocating those income and expenses, you can adjust it. You're not the sole person, which means you're not the only one on the hook for those taxes and liabilities. So this is, again, where we want to strategize with you. What type of business is it? Is it a piece of property that's a rental? Is it land where you're going to be leasing it out? What do you need to protect you and your assets? And do you want other people involved? Now, the multiple owner entities are actually, they can be taxed as an S corporation, which is often a good choice if you are operating a business, in part because this can minimize unemployment taxes. It also can increase your deductions if you're leasing property from the owners. But again, you need to be careful of double taxation. So this is where I keep emphasizing, ask now, let us get you the answers, and make sure that you don't end up with any penalties that otherwise could have been avoided. We again keep talking about gifting. LLCs can absolutely be used for gifting. It can allow you to do this before the gift tax exemption is cut down to that roughly $6 million. I mentioned the federal estate tax sunset provision, and the gift tax exemption works hand in hand with it. So if you are in a position where you're trying to gift in a way that will ultimately reduce your federal estate taxes when you pass away, this is now the time to do it. When that exemption is cut, it is a significant cut. So this, again, is where talking to somebody now allows you to have those strategy options. So again, I know that was a lot of information. Taxes are not things that are simple. They unfortunately are quite complex, and whether we like it or not, apply to everybody in one way, shape, or form. The great news, though, is that here at Copenbarger, there is a lot that we can do. We want to ensure that you are protected, your beneficiaries are protected, your businesses are protected to the highest level that we can offer. As I mentioned at the very beginning, because you attended this webinar, you are entitled to a free consultation. So I very much encourage you, as I keep saying, ask the questions, especially when you get that consultation. Now, one of the things that one of our attendees did want to make sure that you all knew, and I agree, is that there is a movement right now, a group, the Howard Jarvis Tax Association, that is looking to remove Proposition 19. But the petitions for that are coming due very, very soon. They're due on January 16th. So if you do not like Proposition 19 and would like it to be put back on the ballot to potentially be repealed, go ahead and either reach out to us or look for that petition directly to sign it so that it can be then removed. If you are fine with Proposition 19, you can then disregard that petition completely. So when we at Copenbarger meet with clients, we want to make sure that we're really talking about what matters most to you. We will talk to you about your estate planning. Are you properly protected? Are your beneficiaries properly protected? We're going to discuss, do you have a business? Do you have assets that have additional concerns? Do you have charitable giving intent that goes beyond just a simple distribution plan that gets more advanced? What do you want your legacy to actually be and look like once you are no longer here? These are conversations that we start now. That is why we do these webinars. This is why we do client seminars, and it is why they are all free and accessible to our clients and those who are just getting to know us. Because we want to make sure that you have the start of the conversation of, what do I need to know? What does or does not apply to me? And what are some of the questions that I need to bring into my new attorney? One of the big things, though, is it is so, and I keep mentioning it, you need to work with a qualified professional. There are people out there who are attorneys, there are people out there who are tax professionals, but they don't understand the specialized planning that goes into both sides of that coin. Sunny is not only an attorney, she is also a licensed CPA who has done an extreme amount of advanced planning and education throughout her career. So she is someone who, again, not only understands the law, but she understands taxes from the CPA side too. That is a unique combination that I cannot emphasize strongly enough. That when you are looking at your taxes, when you are looking at your planning and how to protect yourself and your future generations and beneficiaries, you need somebody who knows what they're doing and has done it before. And that is absolutely Sunny and her team. Protecting your nest egg is a huge part of it. But again, especially when it comes to Proposition 19, if you are looking at purchasing a new property, come and talk to us first. If you are looking at starting a foundation, if you want to make sure that charitable giving is a large part of what happens after you are gone, again, come and schedule some time with Sunny. We have been around for quite a while. If you've already worked with us, you very likely know we take our client service extremely seriously. We want to make sure that you have what you need and the tools in your toolkit to, again, protect you and your future generations. I hope this was a helpful webinar. Thank you again for attending. You will receive an automated phone call after this from us asking if you are interested in setting up an appointment. Again, to talk to Sunny, it is something that I very strongly encourage if you have any of those questions. But we do have our team standing by. We would love if you would answer a few short questions for us. We just put a link in the chat. It lets us know how we did, if there was any additional information that you needed, if there's anything that we can do better. We do these for our clients, so we want to make sure it's capturing what you need. So just if you could give us that feedback, that would be great. I'm going to stick around for a few minutes just to answer any questions that come in. Other than that, I hope you have a wonderful rest of the day, and we look forward to working with you. One of the questions that did come in is, are we able to amend an existing trust done by another law firm, or do we need to write up an entirely new trust? That is something that we review on a case-by-case basis. We want to make sure that you have all the protections needed. So I would recommend we can do that consultation as well and take a look at what you would need and make sure we get you an accurate look at what that would also then cost. All right, I don't see any other questions right now. If you have any, please don't hesitate to put them in or reach out to us or let us know that you are looking for an appointment. Thank you so much again. We look forward to working with you.